Okay, you guys, we're now going to look at exercise 2012. The Drayton Engineering Group receives royalties on a technical manual written by two of its engineers and sold to William B. Irving Publishing Incorporated. Royalties are 10% of net sales, and they're receivable on October 1st for sales made January through June, and on April 1st for sales made July through December of the prior year. Sales of the manual began in July 2015, and Drayton accrued royalty revenue of $31,000 on December 31, 2015 as follows. Okay, but then when April 1st rolled around, instead of receiving $31,000, they actually received $36,000 on April 1st, 2016. Then $40,000 on October 1st, 2016, and then Irvin indicated to Drayton on December 31 that book sales subject to royalties for the second half of 2016 are expected to be $500,000. Number one, prepare any journal entries Drayton should record during 2016 related to the royalty revenue. And you guys, that's our first instruction, but I'm going to do that one second. Let's go to number 2 first. What adjustments, if any, should be made to retained earnings or to the 2015 financial statements? Please explain. Okay, I thought we would do number 2 first because it's going to tell us how to handle the entries for number 1. They say the fact that, and look at this, the fact that more royalty revenue is received in April 2016 than was anticipated in December 2015 is a change in an accounting estimate. And then a change in accounting estimate is handled prospectively, meaning in the current period and in future periods. Therefore, no restatement of the 2015 financial statements is required. Looks like I need to make a correction there too. Sorry for not proofreading that one better. So what we're saying here, this one falls under our second category, a change in an accounting estimate. It's accounted for prospectively, meaning in the current and future periods. Prior year financial statements are not revised. Okay, so now what entries would we make in 2016? Well, let's take a look at that. Well, on April 1, 2016, and this is instruction 1, we're going to debit cash for the amount received, which was $36,000. Okay, we'll credit receivable royalty revenue for the amount placed in the receivable account at the end of the prior year, $31,000. And then we're going to credit royalty revenue for the difference, the extra that was earned that we didn't realize about at the end of the prior year. We won't go back and restate anything for 2015. Okay, then in 2016, what else happened? On October 1st, we received $40,000 in royalties. So this was received and earned in the same fiscal year. So the entry is fairly simple. Debit cash and credit royalty revenue for $40,000. Then on December 31st, they tell us what that they expect sales subject to royalty revenue for the second half of 2016 are expected to be $500,000. So we're going to debit our receivable account royalty revenue is equal to $500,000. times the royalty percentage of 10%, or $50,000. And then we'll credit royalty revenue for $50,000 as well. Now, if that number turns out to be $60,000 next year, we won't go back and restate 2016 financial statements because, like we talked about, you guys, that one is a change in an accounting estimate. It's accounted for in the current year and in years going forward. Okay, so look for a similar one on the Connect site, and good luck. Thanks.